Hi everyone, I'm Tom Stelzer from Livewire Markets, and today I'm joined by Sebastian Mullins from Schroders Australia to talk about the Schroders Real Return Active ETF. Thanks for joining us, Seb.
Thanks, Tom.
We're going to start by giving us a quick overview of the fund.
Sure. So I guess the portfolio GROW, ETF ticker GROW on the ASX, it's a multi-asset fund. So unlike the other growth managers you might be talking to who are more equity focused, we can invest anywhere in anything. Equities, bonds, duration, corporate bonds, FX, commodities, you name it, we can allocate to all of it. What we're trying to do, though, is deliver investors a real return. So when we say real return, we mean CPI or Australian inflation plus 4 to 5% gross fees. And you can buy the ETF for a management fee of 75 basis points. So for us, trying to deliver that return, real return over a period of time, but being very dynamic in how we allocate. And because we're at Schroders, we're a large institutional house, active house. We have 1.3 trillion under management. We've been doing this for 220 years. So we then allocate to underlying strategies that pick the bonds or the equities bottom up. So within global equities, for example, they'll kick the tires, invest in the companies, but our job is to buy the asset allocation, and then they do the bottom up stock selection. So really it's a mix of top-down asset allocation, which is our job, and bottom-up stock selection, which is the rest of the team globally is their job.
And so what would you say sets it apart from other growth funds?
I think because it's a multi-asset fund, we're never going to shoot the lights out. Because we have other asset classes, a pure equity fund is going to deliver higher returns, but with higher volatility. So for us, it's a nice complement to those higher growth funds that you might be discussing later. So because of that, we actually have drawdown management. I mentioned our return target. We're also trying to minimize drawdowns. When I say drawdowns, I mean negative periods or losses. So because we're delivering, call it a balanced fund style return, but with the conservative funds, volatility, and sell-off, you can actually rebalance us into other growthier funds. So a very nice complement to a high growth or an equity allocation in a total portfolio.
Yeah, I think you obviously just touched on it then, but what opportunity do you think GROW provides to investors?
I think first of all that breadth of exposures, the diversification benefits, we have the ability to go anywhere, anyhow. So we'll have allocations to things like emerging market debt or corporates, commodities, we can choose FX, currencies. We can allocate to Australian corporates or overseas corporates, within equities, emerging markets, individual countries. So a very broad asset class is at our disposal. So again, diversifying your pure equity exposure elsewhere in your portfolio. But we are very active. So to deliver those returns, minimizing drawdowns, getting real returns, we have to move the portfolio around as we see the market change or the environment change. So being active in the asset allocation, plus that activity from the bottom-up stock selection, gives us an advantage over just a buy and hold or buy and maintain stock portfolio. The other two things is because we focus on minimizing those losses, as I mentioned earlier, it can diversify well against another more active portfolio that's more growth orientated. So minimizing those drawdowns help you sleep at night, help you keep your allocation invested, but also allow rebalancing back to other funds that might do poorly in those sort of market shocks. And because we are a listed ETF, we have daily liquidity, but the underlying exposures we buy are also daily liquidity. So there's no mismatch in liquidity of the overall portfolio. So the market is selling off and need to redeem to buy more equities, for example. We do have that daily liquidity to provide to investors.
You mentioned that you invest in a broad range of assets, but how do you decide what makes the cut and what doesn't?
So for us, we have a long process, and I won't go into all of it, but it can be summarized what we call the VCL framework. So that stands for valuations, cycle, and liquidity. So valuations tells you, first of all, two things. One, where do the risks lie? So very expensive assets typically start to fall over time, and cheap assets provide opportunity. But it can give you relative value ideas. Like if you're buying equities, certain markets might be more attractive than others based on relative valuations. So valuations is a starting point. Now we all know valuations are a terrible timing tool. So we start there, but it's not the totality of the process. The next part is cycle, or C, in the VCL framework. That tells you in a business cycle, A, is it risk on, is it risk off? Do you want to dial up your allocation to equities or start to reduce it? If you're going into recession, obviously pull back on your risk allocation, vice versa, if you're going into a recovery phase, but also where to take that risk. Do you want to be in small caps? Do you want to be in high quality growth compounders? So cycle tells you how much risk to take and where to take the risk. And finally, liquidity, a bit of a catch-all, but what are central banks doing, fiscal policy, what is market sentiment and positioning looking like? And that can take a longer term process of valuations, take 10 years to play out, to very short term, 1 or 2 month views on where the market is positioned. So that VCL framework helps guide where to take risk and how much risk to take.
Obviously, key focuses of the fund are minimizing drawdowns and volatility, but what would you say are the risks to this strategy and how do you kind of protect against those things?
Well, the risk is that we're wrong, first of all. So obviously we're making asset allocation calls, we are an active house, so there is a chance that we're wrong. But how we use that VCL framework is because of our dynamicism and because we can move the portfolio around as times change, we're usually faster to market than, say, if you're managing your own book of money with, say, your own ETF portfolio, for example. So we are quick to adjust when needed. Part of the process I didn't touch on is our forward-looking expected returns. We look at that, we know where's the best opportunity to buy from a return perspective, but also where is the probability of loss. It's not volatility, but where can you lose money and what's the probability of losing money in that asset class? That makes us quite unique, that we sort of stay away from potential losses, but also allocate to higher risk or high return strategies. We do use options, listed options. That can cause people to say, oh, that sounds dangerous, but we use that to protect the portfolio. So an example would be from December to March this year, last year to this year, I should say, we had put options in the portfolio. So as we thought the economy was fine, but the market got the Trump story slightly wrong, they were full positive on Trump, forgetting the negatives of Trump. We bought put options as the market fell at the first quarter. We were very insulated from that. And on the way out of it, when we thought the world was ending, we thought, well, if we're wrong on this recession call, we can buy call options far out of the money. So the market does recover, we can participate on the upside. And that's exactly what happened. So by having those calls, we can actually, using options in general, we can alleviate if we are wrong and there's some of those bigger asset allocation decisions. So as you can see on this chart, talking about protecting downside and losing money, the portfolio here, you can see the track record of the funds. It typically has a lower drawdown or loses less money than, say, equities or bonds in a volatile environment, for example. So here, especially 2022, you see the funds fell far less than equities and bonds because we had a sort of inflationary period where bonds didn't protect your equities. But we managed to fall less than both those two asset classes because of that downside protection, because of those things we mentioned previously.
And what role do you think the fund can play in an investor's portfolio?
We mentioned earlier, it's a nice ballast to have in a broader portfolio. So we're not saying give us all your money, obviously not. If you want to have higher risk, go into equities, but if you give us a sleeve, we can move the asset allocation around for investors. They don't have to worry about dialing up and down risk, which can be problematic because it's very difficult to do, but also timing-wise, it might take time to actually implement. But if you look at our asset allocation right now, you can see the diversification we bring. So I mentioned commodities, currencies, and you can also see on the chart here on the right-hand side how we move our equity allocation around. We had 45, 46% equities December last year, brought it down to mid-20s, sort of very early April as the tariff news started to come out. So it's hard for many to do that themselves. So having that downside risk protection, having that diversification benefit from different asset classes, and moving the asset allocation around for you means it's a nice complement to your higher growth or equity allocation in your portfolio.
And finally, where can investors access Grow?
Well, Grow is listed on the ASX under the ticker GROW, Grow. Of course, you can look in the ASX to find more information or go to our website, schroders.com.au, to find more about our listed ETF range.
If you've enjoyed this video, make sure to subscribe to Livewire's YouTube channel for more investing insights. Thanks for tuning in.